So now we have a last panel before the first coffee break from Fidelity, and it's ESG in the era of global rewiring. So we have seen that now, yes, the economy are a bit like trigger, and that we have global shock, and they are going to reshape the portfolio. And so our investor rethinking risk, and it comes just after this great panel from this great discussion that we just had with Kenny and Michael, because we see that ESG is taking a setback a bit everywhere, and we have a bit the feeling that investors lose a bit track of what is exactly sustainability risk. So I think that's also important, because Kenny just mentioned SFDR. To come back to the definition of sustainability risk from the European Commission, is that really the non-financial material risk that have an impact on the value of your investment. And as Michael just recall, is that it's not only climate and environmental risk, it's all your non-financial risks that have an impact, a material impact on the performance of your asset. So it's a bit like weird that everything is a step back. It's like no investor wants to have take into consideration this non-financial risk. No, like the world is a bit shaken. So we are in a world with all this systemic risk, but nobody wants to talk about the non-financial risk. So, but that's a great panel now with Fidelity, that eventually they will solve this question, with them moderated by Solène Garnavolt, and Senior Sales Manager from Fidelity International, and with Jean-Baptiste Fargeau, Fund Selection Manager from Banque de Luxembourg Investment, and Ayla Kosik, for Portfolio Advisor and sustainable expert from Fidelity International. The floor is yours.
Thank you so much. Oh, is it working? No, I don't think so. Is it working? Yeah, I think. Thank you. Yes, so thank you so much for the transition. I think it's perfectly described. We've seen a lot of concepts. We are now talking about, in the real world, how all of this applies, and what's the sense of all of this, taking the shoes of the investors as well as the fund selections and the asset managers' views, of course. A bit of context. So global sustainable funds have seen their purchases shrink by half from 2023, which is quite impressive when we think that in the rest of the fund universe, we have seen very high record flows of collections, because 2024 has been the second largest record when it comes to new fund flows, mainly driven by the US rally, of course. But global sustainable funds have not been part of that. And we are here today to basically try to understand why. And of course, we know that the ESG sentiments from investors have been hurted, I would say, for a couple of reasons. Greenwashing concerns being one of them. Underperformance of the past few years for ESG funds has well been a reason of all of this. But we are really here today to basically discuss this and try to describe and read what we could see behind all of these aspects. So I'm very pleased to be with Jean-Baptiste and Ayla today. And I would probably have a first questions maybe for Ayla to start this session. How have ESG strategies evolved in the past few years? And potentially, how do you see them evolving now with the current political and economical tension?
Thank you. I think as the previous speakers showed it very well, it has been quite a busy year in terms of regulatory developments, in terms of policy environment as well. But I think all the sustainability professionals will also agree it has been a noisy year in terms of ESG backlash. So for me as a stewardship and research-focused professional, it's also an opportunity to take a step back and almost go back to basics. Why are we integrating sustainability considerations into investment processes, into investment decisions? And for us, it's very clear. We continue to believe that integrating those aspects will lead to better financial outcomes for our clients, and eventually for better environmental and social outcomes as well for a broader set of stakeholders. So in that regard, our investment strategies have not really changed. We still consider a sustainability aspect when we deem them material, and we do that through our own ESG ratings internally. I think we also recognize what has been said before is that we are exposed through the variety of our portfolios to systemic risk, whether they are environmental or social. And those risks may not be priced today, they may not have an impact on the share price of investee companies today. But we all know that they are impacting the economies and they will impact companies we invest in as well. So we need to mitigate for some of those risks, whether they are arising from climate change, from biodiversity degradation, or from the rise of social disparities, through our stewardship activities, through our policy engagement as well. So again, those integration and stewardship activities, this perhaps may be disappointing, but they haven't changed. And they remain really at the core of what we do. They remain at the core of the investment process for a lot of our funds, whether we speak about engagement with companies, engagement with certain sectors, or engagement at a policy level, what we call system level engagement. And then, of course, another key driver of sustainability integration is the demand from the clients that we've heard a lot over the past few years. And of course, the market environment has sparked a lot of discussion with our clients about their sustainability preferences and how we integrate some of the recent geopolitical events, for example, into our investment strategies. But again, it hasn't led to major changes to our sustainable investing policy or our strategies. In fact, we continue to receive lots of questions from institutional investors in particular about how we invest on their behalf and how we take into account some of these ESG aspects into our investment processes. And we also continue to see inflows in Article 8 or Article 9 funds, especially, of course, the best performing funds. And earlier in the year, Fidelity has conducted a survey, and so the result can be are available online. But in a nutshell, the survey from institutional investors showed that sustainability remains one of the key elements that they take into account when making investment decisions. So for us, that was a reassuring factor to keep going with our sustainable investing policy, of course. And interestingly, they remain in particular concerned with climate risk, which have been covered quite a lot in the earlier panels.
Thank you, Ayla. I think it's really interesting and probably the right transition to then go to Jean-Baptiste and ask what is exactly the current investor sentiment when it comes to ESG? How do they really look at it at the moment?
Thank you for the opportunity to talk. Do you hear me? Yes. Good afternoon, everyone. You touched it a bit on your introduction. So the level, the amount of assets invested in sustainable funds has decreased a lot recently, and there is a clear sentiment towards end clients that ESG is not something that to invest at the moment. There is this kind of misleading perception that ESG and returns for funds are two contradictory aspects. And this misleading situation has not really changed in the past years. To make it simple, people think that making ESG doesn't bring good performances, and that is false according to me, except if you take into account the SFDR 9 very green or impact funds. And unfortunately, these past years, all the SFDR, most of the SFDR, or most of the ESG funds, sorry, that have came to the market, that have been launched, are managed with quality or growth profile or style management. And unfortunately as well, in the past years, past 2 or 3 years in Europe, these two styles, quality and growth, have largely underperformed. And so it brings to this misleading perception that ESG is linked to underperformance, which is not true. This is typically linked to the management style. And to be honest with you, for our clients, there is this lack of appetite for ESG funds, and we, as professional investors, we are probably not well armed to explain them the differences and that ESG is really something that matters for the future. And so we still have to make some education for our clients and even for our relationship managers internally, just to get that this idea of ESG is important.
Yeah, it's a fair point. I think all these nuances are very important when it comes to education and communication still. And if you look at it with your fund selection hat, what is your views on that?
That's a pretty different story there. As a fund selector, I should comply with my internal group ESG rules. So my group has defined some ESG standards that I have to tackle with. And I also have to tackle with all the ESG methodologies developed by the external fund managers that I work with. And so I have to try and match the internal rules in my group with the methodologies developed by the external asset managers. And that is a bit difficult, to be honest. As there is, I can say, as many different types of methodology than asset managers around the world. And so as a fund selector, what we have done is to tackle ESG through very quantitative data. So what we do, so in the past, we were using some very qualitative assessments for ESG matter. And we've changed it because it brings some biases. The data are not really objectives, the one we receive. And so we moved from years to years to very quantitative assessment in terms of ESG. And so today, the way we do it is we take into account some very static data like SFDR article, the percentage of sustainable assets, for example. And we mix it with very dynamic data. The one, for example, we can say SDG alignments, or that can be as well some principal adverse indicators data that we gather. And so we mix that to obtain a kind of scoring where we rank some funds into their own asset class. And so we can rank some funds from the worst to the best in terms of ESG. And that's how we do it at the moment.
So meaning that all of this is, in a way, moving to a very, I would say, stricter way of looking at quantitative data. Have you, I don't know, embedded some new processes with, for instance, AI tools, or has it evolved in this way as well?
Exact. AI is very important. We try to use AI in our processes. The way we do it is we try to read some documents regarding ESG. There is a large amount of ESG marketings around the world, and so it's very complicated to go through this documentation. And so we use AI for that, and on very specific questions, just to help us to assess the ESG methodology, which is quite tricky.
Thank you. Yeah, so I think with all this quantitative data, transparency of data, and of course regulation that has helped a lot in this field, would you still consider ESG for funds as a true differentiator when it comes to products or comparing products? Or is it more of a hygiene factor now?
ESG is very important. That is for sure. For me personally, I think that ESG is a very risk mitigation tool. We can definitely use ESG methodology as the way we use some qualitative risk ratios financially to assess how a company is of good quality or not, especially for environmental materiality. That is very important in the way we can assess companies, that is for sure. And I guess that ESG is able to limit the drawdown in the price of a company, in the stock price of a company, and limit the volatility as well. So you don't have to consider ESG as a potential alpha driver in the future. So that won't help you to outperform per se, but that will help you to limit the risk of a particular investment in the future. And that will help normally on the long run through a kind of cycle just to mitigate the risk. And that's how I see ESG integration at the moment. And I have several examples in the past of companies that have done some very bad things around environmental aspects and where stock prices have been hurt because of environmental issues.
Yes, thank you. And maybe going back to your quantitative processes, and maybe I will go back then to Ayla for that. How do you see, I would say, the implementation and adaptation to asset managers' processes to it? And how do we finally have some potential upside to this? Because we all have to conform to some strict regulations. But yeah, to go beyond that, how do we adapt as asset managers to it?
I guess all the fund regulation around sustainability and the quantitative screens that Jean-Baptiste just talked about have accelerated ESG integration internally, especially at fund level, creating new dashboards, new I guess trading rules, etc., to make sure we comply with the fund's objectives set out in the prospectus. But I would also say that ESG integration is not all about data and prospectus. I think a lot of it is still down to qualitative aspect. And just to give you an example, all our portfolio managers and their CIOs sit on a quarterly basis to discuss, the fund performance, the decisions they have taken, the risks, the liquidity, etc. And we have decided to expand that discussion to discuss sustainability matters as well. And I think it's really important because there is a lot happening on sustainability fronts that is not necessarily screened out, on SFDR, KPIs or PIs, etc. So for us, it's really important to have this regular forum to continue the discussion with our portfolio managers and to continue to encourage opportunities for integration and for engagement with portfolio companies as well on a regular basis.
Yes, thank you, Ayla. And while maybe looking more at the current shifting macroeconomic landscape, what could be some potential indicators that we could potentially, as investors, look at when it comes to observing companies and discussing companies' opportunities to invest in, and how to potentially find some good surprises when it comes to analyze these companies?
I guess my response is going to be disappointing. There, I don't think there is a silver bullet, really. I mean, there are so many sustainability issues one could look at, so many indicators, so many companies in the portfolios. I think it's really important for us to be able to prioritize which of the sustainability issues we consider are most material to invested companies, and among our portfolios, which companies we consider may be more at risk and we need to prioritize engagement with. I would say there are also perhaps some traditional ESG considerations that are all the more important, today in a world of uncertainties, and basics like, strong governance. We ask our analysts through our proprietary ESG ratings to assess companies' board effectiveness, the quality of management, their incentives, and often analysts would get insight from their interaction with companies' management to be able to feed into that rating. So that's really important, especially as we ask them to get, to take a long-term view and to be as forward-looking as possible in their rating. I think this word has already been mentioned on earlier panel, but I think the resilience of companies' business model is just something that our analysts are asked to look at, as part of their core job, really. And to me, knowing and managing a company's supply chain, being able to respond to physical risk of climate change, being able to identify dependencies on nature, should all contribute to the resilience of their business model. So again, our analysts would consider that as part of their research and as part of their recommendation when they look at companies' approach to risk management, really. And perhaps one of the things that still matters nowadays is the company's reputation. Whether or not there is an ESG backlash, we are still seeing healthcare companies' share price, dropping on the back of product safety issues. We are still seeing, some companies in the luxury sector being cut into investigation for poor labor practices in their supply chain. So I think these are, whether they are tagged as ESG or not, they are still very much relevant, and often we see those share price movements being linked to controversies.
Thank you, Ayla. Yeah, I think, as you correctly pointed out, it's important to really look at companies' fundamentals to try to avoid being trapped in some very specific situation of the current macroeconomic situation. So maybe one last questions before opening the questions for the audience. On my side, I will probably ask you both what your views are on that. Of course, I know no crystal ball here, but if we had to look at what might investors expect and look at to position their portfolios, I don't know, for the next five years. Let's say 5 years is already a challenge to try to have some visibility. But in your view, Jean-Baptiste, I will start with you. What do you think could be something nice? Do we go for standardization, fragmentation?
Very tricky question. The way I see it is, unfortunately, I see that the trend of ETF trackers will probably go on in the next few years. And that will probably increase or support the trends on the markets. And so we should tackle with that in our investment strategy and how we position our portfolios usually. But the thing is, so this implies to be momentum driven. Momentum is like you take the trend and you amplify the trend in your investments. The problem with momentum strategy is that you don't like certain market downtowns, because the momentum strategies cannot anticipate this different change in trends. So you have as well to take that into account when you populate your portfolios. And so my advice would be to adopt a kind of barbell strategy. Barbell means that on one pocket of your portfolio, you should be focused on very defensive positions, and on the other side, you should adopt the trends for the momentum to take. And so I would say that probably on the defensive side of your portfolio, you should invest in more defensive, high-quality stocks, and probably with ESG, high ESG standards there. You could add some anti-fragile assets like gold, very trendy at the moment. And on the other side of your portfolio, maybe you should tackle with the trend, or you should invest in the trends. At the moment, for example, in the US, it's AI, everybody is aware of that. And in Europe, it's more value style. So it means invest in defense stocks, invest in banking stocks as well. So really to adopt two different pockets in your portfolio, just to be able to mitigate the different types of risk in the future. That's how I would do it.
Thank you, Jean-Baptiste. Ayla, do you want to share maybe some of your views when it comes to that?
I guess I come from a different perspective, but from where I sit, I guess we still expect quite a fragmented demand from clients because there are probably as many sustainable investing policies as institutional clients. And we can also see that clients are becoming more sophisticated in their approach to ESG factors. At the same time, if we look at the issuer side, which is very important to our research and stewardship activities, we expect some harmonization on the data that we have access to from companies. Of course, in Europe, we are seeing CSRD regulation being watered down, but globally, we're also seeing an uptake in ISSB reporting framework. And this is now replacing TCFD, and this should enable a bit more harmonization in the data companies provide. I guess we're also continuing to explore how to leverage AI tools into different work that we are doing and exploring new data sets. I think this has been a common challenge to ESG integrations for years, but we're also continuing to see, new offering, for example, based on geospatial data for physical risk or for nature, that is worth considering. And I think as the world evolves and new themes are emerging, we are also expanding our engagement activities to cover this. So I've already mentioned nature dependencies. I think previously speakers mentioned adaptation opportunities, but it could also be, with the rise of AI, what is the impact on workers, what are the human rights implications, and so on and so forth. So we continue to make our engagement strategies evolve along with those new themes.
Thank you, Ayla. It's very interesting. So if I try to summarize all of this, it's kind of an harmonization path to the processes and to the standards, but potentially with some fragmentation when it comes to investment allocations. And for what you've described, Jean-Baptiste, I think that the sustainable funds have a very promising positioning in some long-term investors' views and portfolios allocations, of course. I think we still have a couple of minutes, so probably we can take one or two questions from the audience. There is one there.
Thanks for the presentation. My name is Eros Sharma. I'm a behaviorist. I'm a leadership professional. And Ayla, you mentioned you measure board effectiveness, maybe leadership team effectiveness. So I'm curious, how do you do that? And maybe the second question, and part of the first question to both, would be, what are some of the red flags that pop up for you to say there is a concern on how that board, on how that leadership team is being managed? Thank you.
So I guess there is a combination of traditional factors that you all know about. You know, we give access to our analysts to a certain number of governance-related indicators, to board composition, board diversity, board experience, same on management teams. But then I think there is a lot that our analysts will gain by talking to those people, or talking to people who have been working with them perhaps in the past. And that is obviously more difficult to grasp in a rational way, in a sense. But generally, analysts would look at, the experience that those individuals have, what decisions they have made in the past. I guess red flags could be controversies, or, sometimes minor controversies that, perhaps will lead to bigger ones. That's something that is, I guess, a goal to try and identify. Also, signs may be poor decision, for example, in terms of asset allocation, or just poor dynamics that you could try and sense in the meetings between the management and the board. And, we continue to see some of those red flags at European companies where, unfortunately, you still have some governance issues from time to time.
On red flags, for example, yes, we rely on very strict sector restrictions and exclusions. That is for sure. So, for example, we apply the GOGLE, so this is the Global Oil and Gas Exclusion List in our group. We also use the Global Coal Exclusion List, so the GCEL, that is done by a German association called Urgewald. I don't pronounce it well. And we rely as well on, as you say, some, sorry, I don't have the word, but don't have it. Sorry, don't have the word.
I think it's popping over time, but I'm not scary. It didn't explode earlier. So do we still have time for one last question?
Hello, thank you for the panel. This is around the question around G funds and the Net Zero Asset Management Alliance initiative. I understand that from your speech and panel, Ela, that your ESG priorities are not changing. They're continuing the same from Fidelity International perspective. But I understand that Fidelity International was one of the founding members of the Net Zero Asset Management Alliance that is under the G Funds umbrella. And we know that in January of this year, that ambition was watered down. They paused their signatory reporting activities. What is Fidelity International perspective on this? And are you worried about this trend? Thank you.
Sure. So Fidelity International, so as far as I'm aware, the initiative is still on pause, and they should be announcing before the end of the year their new strategy and their new stance. But I think when it comes to Fidelity International, we have just published our climate and nature report, and we have not changed our plans there. So all our targets in terms of carbon emissions of our portfolios, in terms of engagement with high emitters, or in terms of thermal coal exposure, all remain. And we're still working towards those targets. We're also trying to continue to improve our reporting year on year and to provide more transparency into how we are planning to achieve those targets. And so we have been adopter of the TCFD reports, and now we are continuing to make our reporting evolving to more transition plan, and so that will be published in the coming months as well.
Thank you. Thank you for the questions, and thank you for listening. I think it's probably time for a well-deserved coffee break. But thank you.